Hello and welcome to our weekly look ahead at the markets here. And first up, a quick recap on where we've come from over the last week. We saw stock markets close out a pretty strong January. The Nasdaq finished up about 10% for the month. And the S&P had its best January in 4 years. We saw similar outperformance in Europe and European shares becoming more popular again, European markets becoming more of a popular place for investors to park their cash. And we saw the DAX and the CAC and the FTSE all posting gains for the month. So it was a good month in January. Leading into February, we got that clutch of central bank meetings, and that spurred on some further optimism. Really, we got the impression from the central banks that they think they're approaching the peak in interest rates. So the Federal Reserve very much signalled that, the Bank of England signalled that. The ECB maybe a bit more cautious. It said it will do another 50 basis points of hikes in March and then reassess the situation. But again, it does look like they're looking to do maybe one more hike and then pause. And that's how they see it. The market sees that too, but it also sees cuts coming later in the year. Central banks for now don't think that they're going to be cutting later in the year. And I think really the message from last week was very strongly that the central banks are now once again data dependent. They've spent the last year catching up with inflation. They think they've just about got there. They're coming into the harbour, they've cut the engines and they're hoping to drift in to port. But question mark is now the data. If you're data dependent, you have to respond to the data. And whilst we do see disinflationary trends at the moment, it's not clear cut whether that means we're going to get back to 2% target rates on these headline inflation numbers all that soon. We're starting to see commodity inflation rear its head again. We see wage pressures growing. We also see the stickiness and the broadening of services inflation, which is much harder to put back in the toothpaste tube. In the words of Dr. Karl Otto Pohl, the German economist, who pointed out that inflation, once it gets out, is very hard to put back in. So this is the dilemma facing central banks. They are now data dependent, and that might mean they need to incrementally raise interest rates a bit more than they had anticipated. And they'll be able to do that primarily because although we might be heading for a recession, the labour market is going to hold up because there's a lack of workers. So shortage of workers equates to lower productivity, lower output growth, but wages remain pretty solid and people keep their jobs, which is very important for the consumer sentiment. So in that environment, we think we're heading to a stagflationary type setup, and we might see an unwind of the recent pump in some of these growth stocks that we've seen, the Nasdaq leading the way in January. Some of the real sort of trashy kind of momentum names that are in, for example, the ARK Innovation ETF, that sort of thing, they were really pumped up in January as well. We saw Thursday a huge ramp in the Nasdaq after the Meta earnings. They beat expectations. They were down 4%, but Meta defied expectations for an even worse performance, and it cut its expenses by $5 billion for the year ahead and announced a $40 billion buyback. So Meta roared up 23% on the day. Less promising earnings from Apple, Amazon and Alphabet. That signaled the sort of worry that we've got ahead as earnings expectations come down, rightly so, because we are heading into some real headwinds for all sorts of different companies, and these big tech names are the headlines, the banner stocks, and they signal where the market, I think, is going to head. Remember, we've seen earnings expectations are coming down at the same time as multiples have been increasing. So that's on the expectations that the Fed is going to pivot to rate cuts. But again, as I say, I don't think we're going to be getting there that soon. And I think actually the Fed and others will need to hike a little bit more than they'd hoped for. So coming into this week, we have some central bank activity in the form of the Reserve Bank of Australia. It's expected to raise interest rates by 25 basis points after inflation re-accelerated in the fourth quarter in Australia. So that's something to watch out for. We'll also be looking at the weekly unemployment claims data from the US. Going back to this important aspect of the structural labour market problems, we saw the JOLTS job openings roar higher last week, and that really signalled to me that the labour market remains exceptionally tight, and there is a huge shortage of workers out there, and that translates into gently, or maybe more than gently, rising wage growth pressure and that is going to be a problem for the central bank. So those are some of the headline events to look out for. We've also got earnings from Disney, one to consider after the return of CEO Bob Iger. Does it spin off ESPN? What's in store for the content platform? Does it chase growth, or does it push the content a bit more? And how have its theme parks performed over the last 3 months? We've also got earnings from several big UK companies, so that's going to be important for the FTSE 100. AstraZeneca, Unilever, a new CEO coming in there as Alan Jope departs. What sort of strategy that might entail, maybe spin-offs, maybe offloading some of the ex-growth parts of the business. And also BP, rival Shell, posted record profits of $40 billion last year. We'll wait to see whether BP can join that party. But shares in BP have been doing pretty well lately as oil prices firmed up. So a fair swathe of different earnings reports, economic data and so on. We've got EU economic forecasts as well, look out for that. But chiefly we're looking to see whether the market continues this theme of breaking free from rate hikes and hoping that the peak is in inflation, but also in interest rates, and whether or not that optimism starts to fade as reality starts to dawn on some investors. So that's it for now. Thanks very much for watching.